On Wednesday, the Bank of Canada will announce its interest rate decision and release its monetary policy report. Our next guest is saying that interest rates will in fact rise next year, even though economists have been forecasting rate hikes for the past 4 years. Joining us now for a look ahead is Doug Porter, Chief Economist at BMO Capital Markets, joining us from the Toronto Stock Exchange. Doug, good to have you with us today. Thank you.
No, thanks for having me, Catherine.
Doug, talk to us a little bit about what first you're expecting to hear from the Bank of Canada this Wednesday.
Well, I think it's very much going to be a mixed message. I mean, effectively, since they last reported to us back in January, we've seen the economy underperform in the first quarter, largely because of the weather, as well as relatively weak performance around the rest of the world, whether it's the U.S. or a deeper slowdown in China. So the first quarter was a disappointment, but of course, at that time, they said their biggest concern was inflation that was too low for comfort. Well, inflation since that point is pretty consistently surprised on the high side, and we've got a lot higher energy prices than we expected a few months ago. So it actually looks like inflation could be even a bit stronger over the springtime than the Bank of Canada expected. So they have to try to balance that message out. And just as a little added complication, it turns out growth was a lot better in 2013 than the Bank of Canada expected at that time. I think the message that they will try to send is that they're still worried about inflation, even though it's come up a little bit since their last report. They're still worried that inflation is still too close to the low end of their 1 to 3% range, and they're also concerned about the growth outlook. And I think the way they'll spell that out is that they see, a real disappointment in the export front. Even though the Canadian dollar is down a lot over the last year, even though the U.S. economy has improved, I think they'll focus in on the fact that exports have been quite a disappointment. Not just in recent months, but really over the last year.
So, Doug, what does that mean then in terms of almost the language or the nuances that we'll hear from them this Wednesday? And I ask you that in the sense that will they try to walk the Canadian dollar back down because it has appreciated over the past couple of weeks, perhaps more so than they might want?
Yeah, in an ideal world, they would like to see the currency probably start to soften off a little again. I mean, they're certainly not trying to aggressively push it lower, but I think they're welcoming any weakness that we've seen over the last year with open arms. I think they're only too happy to see the currency do some of the work in terms of boosting growth and lifting inflation. And so the last thing they want to do is come across in any way, shape, or form as being hawkish. So I think they'll try to emphasize again the fact that inflation is still quite low. It's been better than or higher than they expected, but it's still the headline inflation rate is 1.1%. Core is 1.2%. That's still too low. And I think they'll also play up the fact that growth has been a big disappointment and so far this year, and that the growth environment for this year will only be a little bit better than 2%. So I think they'll be very, very careful not to sound more hawkish.
Doug, I'm curious. It seems as though there's a little bit of a disconnect in terms of the language and the commentary that the Bank of Canada has been giving us for the past couple of months versus what these actual results come in at. You, in fact, just pointed out that the results in general have been a little bit better than people were forecasting. What is your true view of the economy right now?
I think we're muddling along. I think we're likely to see growth of just a little bit better than 2% this year. We had 2% growth last year. I mean, basically, the economy is fumbling along pretty close to potential, just strong enough to keep the unemployment rate steady at around 7%, but really not a whole lot better than that. We're basically just waiting for global events to improve. I mean, for all intents and purposes, most of the domestic drivers have done their job. The government sector is largely scaling back, not severely, but we are seeing restraint in a number of provinces. We're still seeing a little bit of restraint at the federal level. We can't ask for the housing sector to do anything more at this point. It's probably going to soften, if anything, over the next year. So really, we're waiting for the U.S. and the rest of the world to get going. And I do think we are going to see better growth out of the U.S. through this year. We're starting to get a taste of that now. We saw the retail sales report today for March, very solid number. We've seen a big drop in claims recently, initial jobless claims. It does look like the U.S. economy was held back by the winter weather, and now we're really going to get going, we think, through the rest of this year.
Doug, let me ask you this. We started the conversation as it relates to what rates might do going forward from here. Do you think that there will be a rate rise next year? I ask you that, but at the same time, too, in one of your notes, I also read that you think that there's a new normal in terms of where the long-term rates will be. Talk to us about that.
Yeah, I think there's two separate issues here. I do think that by next year, the Fed and the Bank of Canada will be very gingerly and gradually raising rates. And that's based on our forecast that the U.S. economy does kick into gear. If we're wrong on that front, then it could take another year. But our official call at this point is both the Fed and the Bank of Canada will be gradually raising rates in the second half of next year. But equally important is we don't think that Canadian rates are all that far away from what we're going to find to be neutral or the natural rate of interest rates in this country. Before the recession began, I think the conventional wisdom was that a neutral rate or a normal rate for the Bank of Canada's overnight interest rate was somewhere between 4 and 4.5%. I think what we're going to find is neutral is closer to 3 to 3.5%. When we finally get back to normal for interest rates. So in other words, the great tightening cycle or the great backup in interest rates that many people are concerned about, especially for the housing sector in the years ahead, really isn't going to be that big of a backup in the years ahead.
Very interesting, Douglas. A new normal for interest rates. Thank you so much for joining us today.
Thanks for having me, Catherine. Bye now.
That was Douglas Porter, Chief Economist at BMO Capital Markets.